Good afternoon, everyone, and welcome to the Japan Exchange Group's Great Market Transformation webinar on how to detect investment signals. My name is Anthony Cohen, and I'm the head of the application specialist for the Asia Pacific region at CQG. As we're approaching the listing of the CME Petroleum Index futures on JPX, I'll be focusing on a few fundamental and technical aspects of the crude oil futures contract and how they can be accessed in CQG. Trading decisions are about finding the right balance between technical and fundamental data. And fundamental data can drive both long, medium, and short-term moves, as we'll see later. To start with, the first fundamental tool I would like to go over is the commitment of traders data that is published by the CFTC. It reports the positions of the market participants, and it is reported by the firms themselves every Tuesday. However, it's published every Friday, which means that this gives us a delayed view of who is doing what in the market. Although it's not really to be used in a systematic way due to the delay in the release, it helps us understand the dynamics of the market, as it will show the kind of players, the type of orders that are likely to come in, and the trading patterns of that market. It's broken down into producers, money managers, swap dealers, spreaders, and other non-reportable positions. And it shows who is long and short, respectively. For example, before you're trying to trade that market, you're able to know that there are spreaders out there, and therefore that this market is tied up to a few other instruments. So in itself, this is doing the groundwork, and it's telling us what kind of indicators we should be looking at. What we can see here is the historical data for the commitment of traders, just to give us an idea of the relationship between the crude oil data and the commitment of traders data. On a more traditional note, let's look at the imports, production, and stocks data, or as it's commonly known, the inventories. Both series are interesting on the long-term basis. The production figures displayed at the bottom right have a meaningful impact, but would usually move the market when the figures are showing a strong deviation or a strong reversal. The stocks data is probably the more interesting out of the three, and most likely to be analyzed. Given the type of instrument that we're looking at, moves are mostly driven by actual supply and demand, which is what commodities is really about. The lower the stocks, the higher the demand, and vice versa. We can actually use this information in various time frames. For example, on the daily time frame, like we're looking at here, we can clearly see that there is a strong relationship between the stocks data and crude data itself. There are, of course, other factors that come into play, which means that the relationship isn't always going to be perfect, but it's strong enough to make it interesting. As you can see on this chart, the histogram below will show the actual inventory values and the corresponding direction highlighted on the bars. Translated into a basic trade system, without any risk management rule, just so we can see the moves in dollar terms, we see that there is potential. This can be played using either crude oil futures or even through options. On an intraday time frame, the impact is a lot more visible. We're looking at a chart of the last few release days, excluding any other days of the week, to get a better picture. We can see the impact on the volume and the volatility around release time, which is highlighted by the blue diamond symbols. The long-term players usually don't worry about those releases unless something really drastic is happening. Medium and short-term players tend to avoid being in the market around that time due to increased volatility that could hurt their P&L, and they tend to get out before the release. The short-term algo traders, however, find very good opportunities on releases and getting on the releases and get out really quickly after that. This is what we're seeing here displayed on the T-flow chart. T-flow is a very short-term time frame which charts the best bid and offer relationship and the volume associated with it. Greener bars are bars where the volume is centered around the offer, and red bars represent volume more on the bid side. We're showing here the actual release time and also the accumulation of the 4 best bids and 4 best offers at the bottom. We see the melting volumes prior to the release itself, which creates this triangular shape, which is zoomed in over here, where the bid prices at the bottom are still at the same level and all of the offers are being taken in the market. So the bars will be green, and then the offer prices move, the bid prices remain where they are. After the release, we can see the volume coming back at the levels where they were prior to the release. Now, let's take a look at the technical side of things. Coming back to the concept that was first discussed, we know that there are a lot of players out there doing spreading between crude and other products. To get an idea of what can be used for spreading, the most natural indicator is the correlation. It compares 2 data series over a certain number of bars. For example, we can compare the daily data of crude oil against the data of gold and see if over 20 bars, the 2 curves show a strong relationship. If both data series evolve in a similar way and in the same direction, the correlation will be close to 100%. If they're evolving in a similar way, but going into different directions or opposite directions, the value will be closer to negative 100%. If there is no relationship between the two, then the value will be around 0. Looking at an overview of the correlation of various depths on various time frames, like 5 minutes, 15 minutes, 30 minutes, 60 minutes, and daily, we can see that, of course, heating oil and gasoline being derived from crude oil are showing a high correlation at multiple levels. But we can also see that there are certain high correlation values between unusual instruments such as crude oil and mini S&P crude oil and Australian dollar, and crude oil and copper. I've also included other instruments such as Bitcoin and Japanese yen futures to show that the correlation doesn't work everywhere. Correlation can be plotted historically to show potential entry or exit signals. If two data series are proved to be highly correlated on a higher time frame, that correlation should be fairly similar on an intraday time frame to create an opportunity. When we look at the intraday data for the mini S&P and crude oil, we see some similarities mostly during Asian hours, perhaps due to the fact that not only the US stock market isn't trading, but also that there are no major release figures coming out around that time. We do see corresponding moves on both instruments, which seems to stop when Europe comes in around 3 p.m. Asian time. When it comes to chart types, one of the important tools for traders is to find liquidity, and market profile does just that. It was originally designed for intraday traders where each 30-minute period was represented by a letter, but it can also be used on a much higher time frame like monthly that we're looking at here, and can be compacted to be more easily readable. Market profile offers a different way to look at data and shows the time and volume per level, meaning that when a price has been actively traded over a period of time, this creates a bell-shaped curve or an accumulation over that price. In other words, this tells traders where other participants are willing to trade, whereas the troughs show where traders are not willing to execute. This information can be useful when trying to get into a large position or to establish potential swings in the market. The last concept I would like to approach is cycles. It's well known that cycles are everywhere, and whether you use a manual process to find them, which would be very subjective, or using formulas, they can come in handy in the decision-making process. We can see an example here on a daily continuation chart where certain cycles are emerging and can provide confirmation of other signals. Each type of cycle here is represented by a different colored arrow. Due to the fact that certain cycles aren't perfect and that they're not easy to identify, the use of easy programming can allow traders and analysts to find more objective patterns. This concludes this presentation, and I'd like to thank you all for your time.
We are concluding our webinar. Thank you so much for joining and hope you were able to gain some valuable insights today. Thank you.